Today's webinar is going to be Energy 101. In this webinar, I would like to touch on some of the deregulation basics, as well as getting a little bit more specific into electricity and natural gas deregulation in the United States. This is the second episode of our summer webinar series. You can view the first episode if you email the marketing team, marketing@emexllc.com. As we continue with these webinars, we will be posting them in your partner portal through the news feed, and as well, some of these items will be in the resource center. So my name is Chris Page. I'm Vice President here at EMEX. In the room, we also have Jessica Bonte, who heads our pricing team. We have Daniel Holdridge, who heads our marketing team. And we will go ahead and get started. So the first thing I would like to go over is just some of the basics of deregulation. What is it? How does it work? How does this affect you? What are the benefits, etc.? So to start with, we have to ask ourselves, okay, well, what is deregulation? The best definition I've been able to find so far is that it's the removal or simplification of government rules and regulations that constrain the operation of market forces. What does that mean? More simply put, deregulation is going to mean choice. You have the choice of who your supplier will be. You have the choice of if you're going to participate in deregulation or not. You're removing the government largely from a component of the marketplace and putting it more in the hands of competitive market forces and end users. So when we're looking at a traditional market structure, we essentially have four components. You have the generation aspect, producing the actual energy commodity, electricity or natural gas. You then have the party responsible for supplying that commodity to the end user. You have the party that delivers that commodity to the end user, and then you have the end user themselves consuming that product. So with the traditional market structure, the local utility company is going to charge a fee specifically for the energy supply, cost of the commodity, and then they're going to charge a separate fee for actually delivering that energy. And when we're talking about delivering that energy, it's going to be over the infrastructure that's in place, the natural gas pipelines, the electricity poles and wires, etc. So if we look at a deregulated market structure, the only thing that's going to change now is the choice of who supplies your commodity, who's going to take over that energy supply. You still have the choice of sticking with the local utility company. You don't have to do anything. The process doesn't change for you. You continue to get your invoice from your local utility company at the prevailing rates that they have established, or you can now switch to a retail energy provider. The energy delivery is still handled by the local utility company. That does not change. Those rates are non-negotiable. That's so the energy supply component is the only thing that changes. You'll notice I do have an asterisk here. In Texas, it's a little bit different. We like to do things a little different, I guess, in Texas. So the local utility companies in Texas do not provide energy supply. So you are essentially forced to find a retail energy provider at all times. The utility still handles the energy delivery, but like I said, they do not handle the supply. It's only going to work like that in Texas. All of the other deregulated markets across the US will work in the format that I have displayed here. So what does this mean to you? What are some of the benefits of deregulation? Well, first off, lower energy costs. That's going to happen through competition. Competition spurs innovation. We're going to have increased investment in renewable energy. So you have in the previous model where there was no choice, there simply wasn't a real, incentive for the local utility company to offer lower costs. The cost is what it costs. You might have you might have older generation that's going to be more expensive. The utility doesn't have the money to invest in cheaper forms of generation. So you're just going to get what you get. When you open up the market to deregulation, now you have more market participants coming in trying to find a more competitive product structure, a more competitive pricing structure. And so the end users will benefit from that. Like I said, you will get the increased investment in renewable energy as well. It's just part of the supplier's product differentiation. One thing that you don't get with the local utility provider is the ability to fix your energy rates. You will be on a tariff with the local utility provider, and that tariff cost is going to change either daily, monthly, weekly, quarterly, or annually. So you don't have any actual control over your long-term energy costs. Through a deregulated market structure, now you have suppliers that can come in and offer you these longer-term products. Say, okay, I would like a fixed price for 1 month, 6 months, 5 years, 10 years, even in Texas. So you have a little bit more control now to set your budgets and get a little bit more certainty in what you're going to be paying each month. You also have, with third-party energy providers, retail energy providers, access to energy products that are customized to your actual consumption patterns. So, like I said, with the local utility provider, you are essentially getting the product structure that has been designated for your rate class, your grouping as a customer. But with the deregulated market now, it's focusing more on the individual user. You can customize your products, what you're going to purchase, what type of product structure you want, et cetera. We also now can give customers greater awareness of their energy consumption patterns. So third-party providers and brokers such as EMEX, we can offer additional tools, resources, software to actually monitor your consumption habits. How can you change them? How can you lower your overall costs? And finally, you get increased reliability of service and improved safety. The argument for this is, well, now you're allowing the local utility company to focus more on their true mandate, I believe, which is maintaining the local infrastructure, managing the energy delivery. You're taking supply out of their hands, putting in the hands of free market forces. Now let them focus on maintaining that infrastructure. Some of the frequently asked questions that I've received over my career experience with deregulation is, okay, if I switch to a retail energy provider, is my local utility going to treat me differently now? Are they going to treat me as a lower class of customer? Absolutely not. So the deregulated market structure mandates that the local utility provider does not discriminate. And really, they don't have any incentive to, because the way that the market is structured is the local utility provider cannot earn a profit on energy supply. They can earn a profit on energy delivery. So really, that should be their focus. Switching to a retail energy provider really just takes that off of their hands, and there is absolutely no mechanism for them to treat you differently. Another question is, so what happens if the power goes out? Do I call my retail energy provider? No. The local utility company still manages the infrastructure. They're still responsible for that energy delivery. If you call your third party, your retail energy provider, they're going to tell you to call your local utility. They're not responsible for that. They have no way of doing it. Another one is if your retail energy provider is not local, are they not going to be there to repair the poles and wires? Once again, local utility provider remains responsible for all infrastructure repairs and maintenance. And this is another common one. So if I switch to a retail energy provider, am I at risk of not having any power to my facility? No. The local utility provider is always going to be there to be more or less the provider of last resort. So you're always going to have service available to you. If your retail energy provider cuts you off, by default, you will go back to the local utility for your supply service. And of course, like I said, this does exclude Texas because there is no local utility provider on the supply component. So let's dive in a little bit more to electricity deregulation in the United States. Learn a little bit more about the origins, how it works, component structures, et cetera. So just to give you a brief overview, if we look back to the early 1900s, there were thousands of small independent power producers who'd basically sell power to anyone who could afford it. So in fact, there was about 3,500 of these across the nation. You could buy power from whoever you wanted. A lot of times the same providers would have their service going through the same poles, and it was definitely kind of a free-for-all when it came to actually obtaining power and the price that you would pay for it. So as we move forward a little bit, here comes the Great Depression. And so of course, about 50% of these power producers are eliminated now, whether it's due to mergers, bankruptcies, acquisitions. And so naturally, of course, monopolies began to emerge. It got to the point before this Public Utility Holding Company Act of 1935 was passed that about 75% of the electricity market was controlled by 8 companies. So the federal government now steps in with this PUCA Act and requires all of these holding companies to register with the SEC. They're now subjected to individual state regulation. And it also prohibited these holding companies from engaging in both regulated and unregulated business, which is big. So it allows them to not monopolize the market, allows free market forces to begin to emerge a little bit more freely. It also creates the Federal Power Authority, which later became the Federal Energy Regulatory Agency, or FERC, which largely has control over energy in the United States. Fast forward a little bit further, here's another big one, the National Energy Policy Act of 1992. What this did was create the exempt wholesale generator. All right, well, what does that mean? So exempt wholesale generators are exclusively engaged in the business of owning and operating generation facilities. They are exempt from certain provisions, financial and regulatory provisions of the PUCA Act, but what they do is they sell electricity solely to wholesale customers. So this allows for some of the barriers to be removed from new market entrants. And I'll get into that as we get to this next order, because it created a bit of a problem when we did this. So in 1996, FERC passed Order 888. A lot of people consider this to be kind of the grandfather of electricity deregulation in the United States. So the first thing it did was it required the public utilities to offer non-discriminatory open access transmission and ancillary services to wholesale buyers and sellers. One of the biggest things that it did was also helps utilities recover stranded energy costs, which was a big, big problem. Stranded energy costs, that's going to represent public utilities' existing infrastructure investments that may become redundant after deregulation. So let's say that you have local utility company A. They have owned and operated this market for the past 50 years. They have incurred significant debt by investing in resources. Let's say for the purposes of this example, they have a fleet of coal-powered generation stations. Well, coal is very expensive, very inefficient. Now let's say that you have new market entrants, these exempt wholesale generators coming into the market. Well, they don't have the existing debt and infrastructure costs as the local utility. So they could potentially come in now and open fleets of natural gas-fired generation and offer this at a substantially lower cost and a much higher efficiency. What would the utility do in this case? Well, they would be stuck potentially in a position where they could not sell their power. It's too expensive, it's redundant, it's unnecessary. So FERC Order 888 addressed this by allowing those utilities to recover those stranded energy costs for the life of that unit, and basically helps absolve them of some of the debt when the market deregulates. And then a few years later, FERC Order 2000, once again, closely paired to FERC Order 888, considered to be kind of the grandfather of energy deregulation. So what this did was it created RTOs and ISOs, regional transmission organizations and independent system operators, the purpose of which is to promote economic efficiency, reliability, and enforce non-discriminatory practices while overall reducing government oversight into the power industry. So moving forward, looking at the modern landscape, here are some of the deregulated electricity markets that we have in the United States. This is not all of them. I'm not going to include lesser developed markets. I mean, there is going to be some opportunity in Washington and Oregon, and if you're using over 5 megawatts, you can participate in Virginia. And now South Carolina has opened up some renewable energy infrastructure. I'm not going to focus on those. I'm going to focus on really the truly deregulated markets in the United States, those that really have an open and fairly vibrant retail energy market. We have California, Connecticut, Delaware. You can read all of them. The only two that I would really point out here is California and Michigan. These are going to operate slightly different because when it comes to electricity, they have a lottery process. They're only going to allow so many people to participate in deregulation. California did this because they were one of the first markets in the United States to deregulate, and being the first isn't always the best. They had massive problems. They actually had to cancel deregulation effectively, put it on hold for a while, and now that they have this lottery system, they are slowly increasing the number of market participants who can engage in deregulation and energy choice. But in order to do so, you have to put yourself in a lottery, hope that you're chosen, and then eventually you can participate. So here at EMEX, we don't really actively engage in those two markets, California and Michigan, because of that process. Once a customer has made it through the lottery process and they are with a retail energy provider, now they can switch at any time. Those are the kinds of customers that we'd be more willing to work with, because getting in that lottery system, it can take several years before you're actually chosen. Another thing I wanted to focus on was electricity generation in the United States. What's the overall energy landscape? And this has been changing dramatically over the past several years. Since about 2008, we've gone through a pretty significant shift in our electricity generation here. And you can see now that natural gas is actually our predominant fuel source across the nation at 35%. Coal used to dominate the market, shrinking down to 27%. And you'll see this chart on the right, it's just going to get more lopsided in favor of natural gas and renewable energy as we go. The reasoning behind this is coal power plants are simply not efficient. It's just more costly to operate. Newer combined cycle natural gas plants can be installed at a significantly lower cost, and they are significantly more efficient. And they're able to dominate the market. It's just free market forces at work. We've been under this transition for quite a while now, but it wasn't until 2014, 2015 that natural gas really started to emerge as the primary fuel source in the U.S. You can see nuclear is still there with 19%. I would expect nuclear to probably continue to shrink as we go forward. Nuclear energy plants, they are very efficient. It's one of the lowest costs of energy when it comes to the actual producing the commodity. Building these plants is very expensive. Operating these plants is very expensive. But mostly nuclear energy kind of has a PR problem throughout the world. And as a result, you're going to see a declining share. But you'll also see renewable energy has taken a pretty substantial increase in terms of the overall mix. An interesting note, so this past April 2019, renewable energy actually accounted for 23% of our total energy production in the U.S. It overtook coal for the first time ever. That's a seasonal factor. It's not going to be consistent. I would think that more than likely renewable energy probably won't exceed coal until at least 2023, but it is expected to overtake nuclear generation by 2020. But there's a lot that's been happening over the past 10 years. We've been building up to this for quite some time. And on Tuesday, August 13th, we're actually going to have a really great co-branded EMEX and Constellation webinar with Brian Havasevich. He's a very talented orator. He has a tremendous amount of data that he can share with you. So we're going to be sending out some invites for that starting as early as next week. But if you really want to learn more about how the energy infrastructure in the U.S. has changed over the last 10 years and how the U.S. has become the number one the number one power producer, I guess, in the world in many categories, please be sure to check that one out. It's going to be a really great webinar. So we'll dive a little bit further into, you can kind of see how the landscape has changed. You'll see that in 2001, coal, of course, was the dominant player throughout much of the country. And now, as early as 2017, you have more of this switch to natural gas, predominantly in the South, just because we have more of the infrastructure for it. You have a strong hydroelectric presence up in the Northeast and the Northwest. And then nuclear is still going to be big in parts of Illinois and Pennsylvania. So what are the actual components of an electricity rate? What makes up your total rate? Well, it breaks down to three basic components on a larger scale. So you have the generation or the supply, which is the only component of your electricity rate that is going to be deregulated through the deregulation process. So this is going to be the actual commodity itself, turning that coal, natural gas, wind into electrical power. And then collectively, the other 40% of your total electricity rate is going to be your transmission and distribution. Think of the transmission as the interstate highway of electric delivery. It's going to move that electricity from the actual generation site over long distances to the substations and into the areas that are actually demanding the electricity. So those are going to be the large power wires that you see running across highways and through some of these other areas. Now, when you go into the actual distribution or delivery component, you can think of that more as the city street. You're going to ramp down the voltage significantly from a transmission voltage to a lower voltage that can be delivered to your home or business. So collectively, about 60% of your total energy rate can be negotiated. That other 40%, that's always going to be handled by your local utility company. It's not something you can do anything with. So let's focus a little bit more on that 60%, that generation component, and that's going to break down into a bunch of other smaller components. Once again, you have the actual energy commodity, the cost of creating that electric power, the load following and shaping component. That's going to be the cost to match the actual energy production to that client's unique profile and to account for unexpected changes in usage over time. Line losses, that's the cost of the energy that's lost during that transmission phase from the generator to the customer's final location. Capacity, this is a component that's going to be in PJM, NYISO, AnyPool, MISO, not in Texas. Texas is not a capacity market, but that's the cost for the generators to be on standby at all times to meet the demand of the electric grid. You have network integrated transmission service, a little bit more unique to PJM. The cost to actually move that electricity from the generator to the customer's location. This is separate in a sense from the actual transmission component, that other 13% that we have labeled there. This is going to be actually grouped into the generation, the supply component. You have ancillary costs. These are costs incurred by the grid operator to actually manage the market, the operating margins, et cetera. This is going to be that independent ISO or the RTO that I mentioned earlier that came about as part of FERC Order 2000. They have to make sure that the market is managed correctly. There's no bias in the market, and they create the actual wholesale market prices. And then last on this list, you have renewable portfolio standards. This is beginning to emerge a little bit more in the East Coast. We're starting to see this as a little bit more developing in certain markets, but essentially what many states are doing is requiring that a certain percentage of all electricity generated and sold within the state adheres to some minimum standards. So right now, one of the big topics in New Jersey is they've recently increased the solar RPS. So a certain percentage of all energy sold has to be X% solar. You know, this is going to vary from state to state. Not all of them have it, but I would expect to see this a little bit more in the future. And there's many other components. There's about 100 components if you want to really get down into the details, but if you really just want to look at kind of the macro overview, these are some of the more major components that we have in the market. And so I also want to focus on some of the key elements of an electricity contract. Once again, there are many. I'm just going over some of the major ones. The first one that we have, which a lot of people are going to be familiar with, is the usage bandwidth, those volumetric swings. These are allowed deviations from your historical predicted or predicted energy consumption. If you go out to procure a contract, what are suppliers going to use? They're going to use your historical usage. Or if this is a new facility, what do we predict that you're going to use over the next 12, 24, 36 months, the term of that contract? Well, we have to have some kind of underlying expectation of what the customer is going to use. So, for example, if we say that you're going to use 10,000 kilowatt hours per month, you can build in that bandwidth, that volumetric swing to apply to that 10,000. If you want to give the customer a 100% swing, which is becoming increasingly more common these days, that customer can now use 0 kilowatt hours or 20,000 kilowatt hours that month without incurring any kind of penalties. So corresponding with that is material adverse change. This is not a clause that all suppliers have in their contract, but it's definitely become a lot more common. This is, I don't want to get too detailed here, but in a nutshell, it's going to govern how the customer consumes energy over a longer period of time. Kind of going back to those components I mentioned, capacity and network integrated transmission, it's going to be associated with those components mostly. I guess one way to break it down would be, let's say that you are operating an ice cream shop, you know. Sure, you're given a bandwidth of 100%, but now let's say that you want to start manufacturing ice cream out of that facility. Well, you have a significantly higher energy demand. It's dramatically affecting the shape of that profile and how much energy the customer is using. So it is going to differ from that usage bandwidth. Like I said, I can get a lot more technical into that, but I think I'll hold off for right now. What's the billing type? How is the customer going to receive their bill? With a utility consolidated billing format, the utility will continue to send you your bill, and they're going to remove their energy supply charges and insert your supplier's energy supply charges. It's the most common way of doing this. There is a premium for that, of course, but it is becoming more standard for retail energy providers to move forward as their default billing method. You also have dual billing. You'll receive one invoice from your local utility provider for your energy delivery, and you receive a separate invoice from your retail energy provider for the supply. And then finally, you have a summary billing option, which this is going to be best for customers that have a lot of locations rather than, let's say you have 100 locations. Well, you can choose to receive 100 bills detailing your electricity supply charges, or you can condense that into one bill that will list all of the locations on it. You're still going to receive 100 invoices from the utility for your energy delivery, but this does help consolidate things quite a bit and make it a little easier for the customer. So the three of those I would consider to be fairly standard elements of an electricity product. You do have two additional non-standard premiums, as I would label them here, an add delete clause, as well as green energy. Add delete clauses. These are going to be great for customers who operate in multiple facilities and they don't know how many of these facilities will need to be added or removed during the term of contract. So adding this clause would essentially apply a percentage to their expected monthly or annual consumption. Once again, going back to that 10,000 number, say, okay, well, I'm expected to use 10,000 kilowatt hours each month through all my locations. Well, we can now say, okay, well, here's a 25% add delete clause. You can add or delete locations that would take up 25% of that 10,000 kilowatt hours each month. It's very different from a usage bandwidth. When you're talking about actually adding or deleting locations from your contract, your bandwidth is not going to cover that. So this is an important clause for those customers, like I said, who have a lot of locations and they're just not certain which locations will be added or removed during the term of a contract. You also have the green energy premium. By default, you will get the state's RPS requirement. If they say all energy has to be 10% renewable, that's what you're going to get by default. But you can add additional green energy to your energy contract at an added cost if you wanted to move up to an aggregate of 25, 50, 100% green energy. So I'd also like to look at some of the common electricity product types. We have this product cost and risk continuum here. If you look at the left axis, the range of supply outcomes, you kind of have this, I guess what you could call a cone of uncertainty extending from left to right. As you move from your fixed product to your hybrid product to your variable index product, the range of cost outcomes is going to differ quite a bit as you start stripping some components out, allowing certain components to be fixed at a rate and certain components to be passed through at market cost. So that's going to correspond with the overall risk premiums that are going to be included in your rate. You know, the supplier, whenever they fix any costs in your contract, there is going to be a risk premium associated with that they're going to include in that cost. So the more products you unbundle and allow to move at market forces, you're going to just have a corresponding lower risk premium. So the first and most common product type that I'll get into is your fixed all-inclusive product. This is the product that we sell most of the time. I'll break down this chart a little bit here. So this dotted purple line is your hypothetical market conditions. You see the cost of energy is fluctuating over time. When you lock in that fixed price, you're just saying, this is the cost that I'm going to pay for the duration of my contract. The market conditions might be higher or might be lower. So the way that you look at it, you could be underpaying or overpaying at any given point in time, but you have to look at it for the term of that contract. It's just a lot like buying a stock. You don't know if that price is going to go up or down. You're making an educated guess, a bet, a hedge, if you will, into what you want to pay for that product. As always, there's going to be a pass-through risk. Those of you who have been in the market a little bit longer, you will know that, especially in markets like New Jersey, for example, there are going to be pass-through costs over time. The government, the regulatory agencies introduce a new cost component, or they increase the price of certain cost components. Suppliers can't absorb those costs. Whenever they can, they're going to try to. That kind of goes back to that risk premium I talked about. It's never going to be good to pass through items on a customer's bill. It generally rubs people the wrong way. But at a certain point, you have to, if we didn't allow for that, every supplier in the market would have to go bankrupt at some point. So as you move forward in time, the risk of having market developments which are going to create that pass-through risk will become more prevalent over time. So one of my favorite products is fixed with pass-through. So this is going to allow you to fix certain components. Let's say energy, for example, one of your primary components. and allowing certain components like capacity and network integrated transmission to float at the market rate. That way, if you're in a market, once again going back to New Jersey, I like to pick on New Jersey, where the cost of these components is frequently up in the air, it's as a consumer, I would prefer those costs to be passed through at the prevailing market rate. That way, I know what I'm fixing. It's more transparent on my invoice. You know, I'm paying 5 cents for my energy. Now, bill me for capacity and network integrated transmission at whatever the price is going to be. So this does create a little more of a moderate market risk. You're going to have a little bit more price uncertainty, but I think for a lot of users in certain markets that are more at risk, I think there's just a little bit more transparency to this type of product structure. We also have a block and index product. I'm not going to talk about this one a lot. It's not a common product in the marketplace these days, not as much as it used to be. We have more developed billing systems to create more preferable hybrid products. Those are going to vary from supplier to supplier, but basically what you can do here is it's a compromise between a fully fixed product and a fully indexed product. It allows you to set certain energy blocks. This is going to be an ATC block around the clock, 24 hours a day at a certain price, or you can do it by on peak, off peak. You can have certain months have certain block sizes. It's a fairly complicated product, not for everyone, but it can be more favorable for, I would definitely say, manufacturing type organizations, especially if you want to shift more of your usage from the on-peak energy hours to the off-peak energy hours and have certain costs associated with only those hours. And the last product that I'm going to get into for electricity here is your index plus adder. This is going to be your highest risk. You're going to have the least amount of price certainty. You're paying whatever the market dictates. So the bottom blue line, that is the index price in your area. You are placing an adder on top of it that can be fixed. It can be also variable. Let's say for this instance, it is fixed. So I'm saying, okay, I'm going to pay the index plus 1 cent per kilowatt hour. You add those two together, you get your total rate. You'll see that it's going to vary quite a bit over time by month. So let's shift gears now. Let's talk about natural gas deregulation in the United States. Once again, go over some of the origins of deregulation. You know, we started off using coal gas in the, really for quite a long time. Coal gas was just a byproduct of coal production. Extremely dirty, extremely inefficient, and we were very dependent on this for quite some time until we really started to be able to produce and extract this natural gas with more ease. So, as we move forward in time, we start to eliminate coal gas usage in favor for natural gas, and this industry really starts to explode from 1920 to 1970. And of course, with any newly emerging industry, this creates problems. So we looked at the passage of the Natural Gas Act of 1938. This allowed the U.S. federal government to take jurisdiction over the regulation of interstate natural gas prices. This specified that no new interstate pipeline could be built to deliver natural gas into a market that was already served by another pipeline. So it really had a very restrictive impact on free market forces here. And the rationale for this was they were so concerned with the heavy concentration of the natural gas industry and the monopolistic tendencies of interstate pipelines to charge higher prices than competitive prices would be due to your market forces. And in 1954, this kind of came to a head with the Phillips Petroleum Company versus Wisconsin. And ultimately, the federal government deemed that it was necessary for them to go even further and regulate prices at the wellhead, which is the rate at which producers sold natural gas into the interstate market. Fast forward in time, all of these items continue to create problems. We look at the passage of the Natural Gas Policy Act of 1978. And this was where the federal government lifted those price controls off of the wellhead that were established during the NGA 1938. And now we're at a point where we can allow market forces to determine the price of natural gas. And so this was, I don't know if some of you remember going back in history, but this was enacted in November 1978 at the peak of natural gas supply shortages, where we had the oil embargoes and a lot of constrained supply. And ultimately, the government realized that the price controls that they put in place to protect customers from monopoly pricing had really come full circle, and it was starting to hurt people, hurt consumers in the form of natural gas shortages. And the last thing I'll touch on here is FERC Order 636. So just like FERC Order 888, this was opening the playing field, so to speak, to create a more open and equal environment, allowing market participants with equal access to transmission, distribution, and storage. So just like FERC Order 888 is kind of considered the grandfather of electricity deregulation, FERC Order 636 does the same for natural gas. Quickly look at some of the deregulated states for natural gas. You'll notice that there are quite a bit more states deregulated with natural gas. And really, I consider just about every state to be deregulated for natural gas. It just depends on how much you use. We've negotiated several deals in Kansas and Oklahoma, Arkansas, Louisiana, Tennessee. These are markets that I have listed here as regulated, but if you are a very large industrial user, you can take delivery directly off of a pipeline. Most markets are going to allow for you to participate in a deregulated environment. Just to set the stage a little bit more, I want to go over some key terms that might help you out when we move forward through natural gas here. We're going to talk a lot about dry natural gas. Well, what's dry natural gas as opposed to wet natural gas? So dry natural gas contains at least 85% methane. A lot of the hydrocarbons such as ethane, propane, butane, et cetera, they've all been removed now, and they can be sold as their own independent products. Once again, in this webinar that we're going to have on August 13th, we're going to talk about how the U.S. is the hydrocarbon superpower of the world when it comes to all these additional hydrocarbons such as ethane, propane, butane, et cetera. We lead the world by a very, very dramatic margin in a lot of these categories. What is pipeline natural gas? So pipeline natural gas, it's dry natural gas that has additional contaminants such as nitrogen, sulfur, water, and carbon dioxide all removed. So this is now fit to move throughout the pipeline system that we have in the U.S. Shale gas. This is another big term. A lot of you are probably familiar with this. So shale gas is natural gas that is found trapped within shale formations, which are fine-grained sedimentary rock such as sandstone and limestone. And it's often going to be extracted by the process that everyone knows as fracking. This is a little bit different from tight natural gas, which is also removed by fracking, but this is gas that is removed from reservoir rock, which is a little different. So there is a distinction there, and we do treat it as such when we look at some of the statistics associated with it. And last, I want to make sure that everyone understands what associated gas is. Associated gas is natural gas that is extracted as a byproduct of crude oil production. So you can break it down a little bit further to say, okay, there's two ways that we extract gas. It's either as a byproduct of crude oil extraction, or if it's its own independent natural gas well. So where do we produce this natural gas? Where do we get it from in the United States? Well, we have some of the major natural gas production zones here. You can see the Bakken, the Niobrara. Texas has a large concentration with Permian, Anadarko, Haynesfield, Eagle Ford. A lot of these areas are going to be where a lot of our associated gas comes from, especially Permian, Eagle Ford. We have a lot of crude oil operations there. So a lot of natural gas production in Texas is going to come through that associated natural gas production. So as of 2017, Texas, we were the #1 dry natural gas producing state in the nation, followed by Pennsylvania. You'll see, I didn't touch on this, Appalachia, which encompasses the Marcellus and Utica fields. It's been combined recently to have the all-encompassing Appalachia name. So the Marcellus field, which is predominantly in western Pennsylvania, is actually the largest producing natural gas field in the U.S. by a pretty good margin. And this largely came about through shale gas exploration and fracking. There was a time not too long ago when, go back to 2005, after Hurricane Katrina, we had so much production coming out of the Gulf. When Hurricane Katrina moved through there and decimated a lot of that production capability, you saw prices increase dramatically. Coming into 2008, during the perceived oil shortages, when we were talking about, you know, we're going to start seeing declining oil production around the world, and we're going to be in this huge energy crisis, and, you know, natural gas, there wasn't enough of it, and so once again, prices spiked out of fear. And then we started discovering how much gas we had in this Marcellus field, and that dramatically altered the landscape of the United States. See right here. So right around 2008, that's when we started to realize just how much natural gas that we had. And you'll see just how much of this shale gas production determines our overall dry natural gas production in the United States. I mean, we're projected by 2040 to have almost 42 trillion cubic feet of dry natural gas available. Dramatic. I mean, we're looking at, go back to 2007, 2008, at just half of that. So very, very dramatic increase in production. And if you look to the chart on the right, that top area, the green area, that is the Marcellus shale field. You'll see just how much. Combine that with Utica, that's about 40% of our total natural gas production coming out of just that area. So that was a big discovery. So what are we going to do with all this natural gas? Well, here's some projections out to 2050. The biggest growth areas are going to be through electric power. Like I said earlier when we were talking about electricity, natural gas-fired generation is the dominant fuel source in the U.S., and that is expected to continue to grow. So a lot of our consumption will be occupied by that industry, as well as the industrial sector. There are a lot of chemical and fertilizer plants that have recently come online, and those coming out in 2020 as well. We really do expect a dramatic increase in overall industrial natural gas consumption in the United States. It's going to be a very growing field. And, you know, you have residential and commercial, moderate increases, mostly, you know, corresponding to population growth, but for the most part, fairly flat growth. Quickly want to go over how some of the natural gas is moved in the United States. So here we have this map of our vast natural gas pipeline network. Over 305,000 miles of interstate and intrastate pipelines. This is going to be moved through 1,400 compressor stations. The compressor stations are what actually pumps the natural gas through the pipelines. There's over 11,000 delivery points, 5,000 receipt points, 1,400 interconnection points. And in 2017, we delivered 25 trillion cubic feet of natural gas to 75 million customers. So with natural gas, one of the benefits is that we're able to store it. We are ramping up that ability on the electricity side as well through some of the battery technology that we're coming out with, but there aren't really a lot of real efficient ways to store electricity, but that's quite opposite with natural gas. We can store it in salt caverns, mines, aquifers, depleted reservoirs, which are depleted natural gas fields, and hard rock caverns. The depleted reservoirs is going to be the most common. If you look at the map on your left, though, you will kind of see a little bit more of which is more common in certain areas. These salt domes, salt caverns are predominant in here in Texas and the Gulf Coast. They're a little bit more expensive to build, well, quite a bit more expensive, but they are very efficient. So corresponding with storage is the natural gas storage report. A lot of you are probably familiar with this. Every Thursday at 10:30 a.m. Eastern, the natural gas storage report is released, and that's going to give us a better sense of how much gas we have in storage as we enter winter. So we have the injection season and the withdrawal season. Withdrawal season, of course, is going to be during the winter months where we are consuming the most of our natural gas. So we have to have a good idea of how much gas is going into storage during this injection season. It's kind of like a squirrel putting away nuts for the winter time. You have to make sure that you have an abundant supply that you can draw from. If you'll notice that the market will go up or down based on this report every Thursday. Thursday is going to be the most volatile day for natural gas trading just because of this one report right here. So if we get to a point where we feel that we are not going to have adequate supply for the upcoming winter, you will see prices increase. So right now, as of the June 28th report, we have almost 2,400 billion cubic feet BCF in underground storage. That is working storage. Our overall storage is going to be higher because when you're talking about storage, a certain percentage of the natural gas being stored is working storage. It can be extracted, it can be added. And then you also have natural gas in there to maintain the overall pressure because you don't want the storage reservoir collapsing on itself. But altogether, we have the ability to store about 4,000 BCF in the United States. So what are the components of a natural gas rate? Unlike electricity, I wasn't able to really find any good numbers that I felt comfortable with. Largely, yeah, you can kind of think of it in the same percentages. Roughly 60% of your total rate is going to be your supply, and the other 40% is going to be your transmission and distribution. Like I said, I couldn't find numbers that I really felt comfortable with, so I thought instead we'd just kind of look at this process overall. It's the same roughly as electricity. Your production, your supply, deregulated, you can negotiate that rate. The transmission, or basis as we call it, natural gas, is regulated, but it can be hedged. And then the distribution delivery, once again, is going to be regulated. So just quickly moving left to right here. So you'll see that the natural gas is sourced from both those oil and gas wells, or just the gas wells. It's separated. Some of it's going to be vented and flared. It's going to go through that natural gas processing plant where all the additional products are removed, the contaminants are removed. It goes through the compression stations, moving that gas along the interstate and interstate highways. You have some customers, like I said, those large users who can take delivery directly off of that pipeline. Some of that is going to move to underground storage. As we get more towards the retail sales, the end user sales, your common residential and commercial base, you're going to have that odorant introduced to the line, the rotten egg smelling odorant that we inject in there. That way you can more easily detect a leak. It's going to flow down to the natural gas company who is going to sell the product to the end user. And when we get to the key elements of a natural gas contract, it's largely the same as what we discussed with electricity. You have the overall usage and bandwidth, the allowed deviations from predicted or historical energy consumption. The one thing that I will point out is this is much more closely monitored with natural gas. With electricity, it's very common to get that 100% bandwidth. And a lot of times suppliers really don't have any way of tracking that. There aren't a lot of mechanisms in place, so it's actually hard to get dinged for going outside of your bandwidth on electricity for the most part. But with natural gas, not the same. a little bit more tightly monitored and controlled. So I would say it's imperative for you to negotiate a usage bandwidth that you do feel comfortable with. You're also going to more commonly see with natural gas suppliers a 0% or a 10% usage as kind of usage bandwidth as their default, but you know, you can pay a higher premium to get up to 25% or 100%. The other thing I'll point out is that delivery location. Where's this gas going to be delivered to? Is it going to be delivered to the city gate or the burner tip? Going back to that, let's go back to this real quick. So like I said, these pipelines, you can think of them as highways. So the off-ramp, you know, taking that exit into the city would be considered the city gate. Now, the end user is going to have to pay a little bit more of a premium to take it from the city gate to their actual burner tip, their physical location. You know, or you can just go ahead and dictate in the contract that the gas is delivered to the actual burner tip. There's no additional fee to move it from the city gate to the burner tip. You can also negotiate the billing type, exactly the same as what we discussed in the electricity phase. You can have utility consolidated billing, dual billing, summary billing, and then also, once again, the add delete clause will apply as a more of a non-standard premium. So let's quickly look at some product types. Once again, going back to our product cost and risk continuum graph here, the cone of uncertainty moving from left to right. The more items that you do not fix as a part of your rate, the higher the cost outcome, the more uncertain the cost outcome. Just like with electricity, the most common is going to be your fixed all-inclusive product. Once again, the market conditions are signified by this dotted purple line, and you are fixing that price as you go through your contract. So, like I said, it is the most common product. You have a low market risk, a high price certainty, high budget certainty. It's going to be the preferred product for a lot of users. For your larger users, a managed product is definitely more of a recommendation. This is a good hybrid product where you are having fixed prices during a certain term of the contract and paying market price during the rest. Some suppliers that have the systems in place will allow you to set price ceilings and price floors. You can have automatic triggers. You know, if natural gas hits $5 in MMBTU, we're automatically going to lock in your price at that level for a designated period of time to protect you from a rising market. Or let's say that you are very confident that maybe the price will get down to $2 in MMBTU and said, you know, if it hits this level, lock me in. You can set those triggers as well. Not all suppliers have the capabilities of doing this, but if you are going to have a client that wants to have a more active stake in managing their portfolio, this is definitely a recommended product here. It's going to have some moderate market risk, moderate price uncertainty associated with it, but that's going to vary based on how much of the overall supply is fixed versus floating on the market, and price ceilings, price floors in place, et cetera. We're going to be wrapping up soon, so if you do have any questions, please submit them now, and we'll be ready to take those as soon as we get through these next two slides. So the last product I'll go through here is the NYMEX Plus basis. It's the same thing as on the electricity side where you have the index plus adder. The NYMEX Plus basis, remember basis is going to be our transportation component that we can hedge. And ultimately what basis is it's the difference between two price points. So in the United States, the Henry Hub located in, I don't know if I'm going to pronounce this right, but Erath, Louisiana, that's going to serve as the local hub for pricing in the United States. We're going to price that through the New York Mercantile Exchange, otherwise called NYMEX. So if you wanted to look at an example of what basis really is, if your delivery point in Boston, Massachusetts is $3.50, NYMEX is at $3. Your effective basis price is 50 cents. So with this, of course, you're going to have a high market risk. You're not going to have the price certainty that you're going to have with a fixed all-inclusive product. But one of the benefits of, if you do go on this NYMEX plus basis product, you can always kind of revert back to this managed product. Most suppliers, if not all, will allow you to lock in gas during certain times. You can say, okay, well, I don't use a lot of gas in the summer. I want it to float on the market rate. But during the winter, when prices are going to spike, I want to make sure I'm locked in. You can lock in those months and protect yourself and not have to worry about some of that associated volatility. But it can be a little bit more expensive if you don't pre-negotiate some of those fees right offhand. So definitely, if you do plan on engaging in a managed product, I would not recommend just simply going with a NYMEX plus basis product with any supplier. You need to make sure that they have the actual capabilities to set floors and triggers, and what are the costs going to be for making those hedges for you, et cetera. So that wraps me up. That's everything I really wanted to talk about. So if we do have any questions, we'll take those now and give everyone a couple of minutes here to finish typing some of those in. All right, so we do have a question here from Stephen. What do you predict will be the next state or states to become electricity deregulated soon? That's kind of up in the air. Good question, though. There are a lot of states currently looking at opening up a deregulated market structure. I mean, you have Arizona. There's a experimental rider in place right now. You have certain markets like Washington and Oregon that are, not quite developed, but might move to a more developed structure. Florida, they're always making the push there. We looked at Nevada, but that was shot down in the last election. Indiana, Kansas, they're also looking at it. I mean, if I were to name a state, I would probably go with South Carolina right now, just because they've actually made some of the steps necessary. Recently, they passed legislation to allow large users to purchase renewable energy. It's a little bit complex. It still has to go through the utility. The utility is actually the one purchasing the renewable energy from those generators. But out of all the states who are talking about it right now, I mean, they at least have something concrete put into place right now, and it kind of sets the stage for opening up deregulation more in the future. Okay, we have a question from Mike. Do we offer load following products versus block and index? Yes. We actually just had a large auction yesterday. So yeah, we had a customer in Pennsylvania. They're using about 150,000 megawatt hours annually. And yeah, we put them on a load following product structure that we got them. So they locked in their power at like 2.8 cents per kilowatt hour, plus an index adder. They locked in 80% of that at 2.9 cents, and so altogether their total expected all-in price would be about 3.2 cents. So yeah, it's a very aggressive product. It's great. You have to have the right load profile for it, but more suppliers are offering it. It is a very viable opportunity. Something to look forward to going forward. Okay. Oh, so another good question from Stephen. So, all right. So as we talked about in FERC orders 888 and 2000, yes, the federal government did provide the groundwork for all of the markets potentially to be deregulated. But at the end of the day, it is the state's decision whether or not they are going to allow deregulation to take place. So it is allowed on a federal level. The framework is there, but at the end of the day, it's up to the states. Okay, a question from Renee. Do you have a list of gas utilities where the transmission from city gate to burner tip is paid by the utility? No, actually, I don't have a full list of those. That's a good question. I can work on putting some together, though. Primarily, when I was discussing that, when you're negotiating a contract with your retail energy provider, that's going to be a component of their contract. Some of them can only do city gate by default. Some of them can only do burner tip by default. So it's just something that you have to pay attention to. It's something that is I would say commonly missed with a lot of people when they're actually looking at the contract. Let's see. Can we get a copy of this presentation to be used as part of our sales training? Yes. Good question. So I would say expect by Tuesday, maybe Wednesday of next week, we will post this to your news feed in the partner portal. We will also make this available in the resource center. We just have to edit it a little bit and kind of get rid of some of the dead space in here and give you a good copy, and yeah, we're ready to go. And okay, we have one question here from John. A year or two ago, there was some talk about possible deregulation of electricity in the city of Austin. Any new development? None that I've heard of. We do have the city of Lubbock integrating into Texas, the ERCOT system. I believe that's happening next year, maybe 2021. I don't have the number in front of me right now. But yeah, that's almost as good as a new state opening up when you have the city of Lubbock, Texas, home of the mighty Texas Tech Red Raiders. Yeah, so that's going to be opening up fairly soon, and that's going to be a great market for us to start penetrating. So, all right, it looks like that is all of our questions for this time. I do want to thank everyone for joining, and like I said, we will make this this webinar available for download and viewing early next week. I hope everyone has a great weekend. Please stay tuned for additional webinar announcements. We will be sending those out shortly. Thank you very much for your time, everyone.